On August 5th, 2024, all the global markets in the world were showing a potential crash.
It was a bloody Monday for all the traders. Today, stock markets across the globe witnessed a massive crash.
And the stock market is opening in the red this morning after a rough finish last week on a weaker than expected jobs report. The Dow's down more than 1,000 points as that global sell-off intensifies.
The U.S. markets fell significantly, wiping out almost $2 trillion from the market. All of this was triggered by just a small change in Japan's banking policy. In the late 1980s and early 1990s, Japan experienced a significant asset price bubble in the real estate and stock markets. When the bubble burst, it led to a prolonged period of economic stagnation and deflation. To combat this deflation, the government introduced negative interest rates. For years, Japan had negative interest rates. The Central Bank of Japan charged commercial banks to keep their money with them. It is like if you keep $10,000 in the bank at a negative 1% interest rate, then you had to pay $100 to the bank as a fee. Because of this negative interest rate, the Japanese banks were lending money at very affordable interest rates, which incentivized people and big companies to borrow more and spend more money. This decades-old practice of offering low-interest loans changed last week when the Japanese government decided to raise the interest rate to 0.25%. This 0.25% hike doesn't look like much, but in a country where there's been no interest rate for the last few decades, it is too much. But the biggest reason for the US market fall was the big investors doing a carry trade. What is a carry trade? As the Japanese banks were offering loans at very low interest rates, lots of big investors, like hedge funds and institutional investors, took the loans from the Japanese banks in yen. Then they converted that money to USD and invested in the US market. But as Japan hiked the interest rates, these big hedge funds and institutional investors got in trouble, and they started to sell their positions in the US market, ultimately causing the market crash. Let's see how this carry trade actually works. The first step of the carry trade is that the traders borrow money from low-interest countries. In this case, it was Japan. Then they convert that money into another currency. In this case, it was converted to USD. Once converted, they invest that money in the US stock market, where you get a higher return on your investments. For example, let's say someone borrows 1 billion yen from Japanese banks at a 1% interest rate. Then he will approximately get around $7 million. That person takes those $7 million and invests in the US market for a return of maybe 5%. So the trader makes around $350,000 after investing in the US market. So now he has a total of $7,350,000. Now, the trader will return the money to the Japanese bank at a 1% interest rate, which comes to a total of $7,070,000. So, in this trade, the traders made a profit of $280,000. This is what an ideal carry trade is, and it used to happen with billions of dollars, where big investors and hedge funds used to borrow billions and make money on the interest rate difference between the two countries. Now, what could go wrong in this trade, and what exactly went wrong with recent changes? The first thing that could go wrong is that the USD-yen exchange rate could go down. Let's say the exchange rate goes down by 10% and you still owe 1 billion yen to the Japanese bank. Now that the USD-yen exchange rate has gone down, you need more dollars to pay for the same 1 billion yen. Previously, you just needed $7 million to pay off 1 billion yen. After the exchange rate went down by 10%, you will now need $7.7 million to pay the same 1 billion yen. Now, even if you make a 5% return on your USD investment, you still have a loss of $350,000. The second scenario is that your USD investment value goes down. Let's say the value of your USD investment goes down by 10%. Now, the value of your investment is just $6.3 million. To pay the 1 billion yen with interest, you need $7.07 million. In this case, you made a loss of $770,000. The third scenario is that the yen interest rate rises from 1% to 4%. To pay back 1 billion yen with interest, you need $7.28 million. you have to pay $280,000 from your original $350,000, reducing your total profit to just $70,000. Imagine all of this happening at the same time, and the losses made by this trader will multiply several times. That's what happened on August 5th, 2024. The Japanese markets raised the interest rate by 0.25%. This caused carry traders to panic and sell off their positions in the US market, as they were getting margin calls from the Japanese banks to pay back their money. What exactly is a margin call? I've explained this in this video while explaining the margin call movie. Make sure you watch it. This cost $2 trillion to wipe out of the US market, triggering the start of the potential recession. With the rise in interest rates, the yen has strengthened against the dollar, which means that the dollar has weakened slightly. I already explained in the last video how a weak dollar is bad news for the US, as it will have to pay a higher interest rate on its national debt. Watch this video to understand the US national debt crisis. The market can change anytime, and when that happens, the money in your bank won't be enough, as it will lose value. That's why you need to invest your money for good returns to secure your financial future. For that, you need value investing. And to learn more about value investing, subscribe to this channel and our newsletter on our website.